with that said, I'd like to hand you over to Fernando.
Thank you very much, Vishnu, and great to be here. Good afternoon. Thank you. Yeah, very happy to be here. This is my first time ever in Guyana, so very glad about this, and thank you all for coming. Hopefully, you're going to find this information interesting, and hopefully also you will apply to this program. And if for some reason you think that you don't have necessarily a project under development at the moment, maybe you know someone that could actually benefit from what we have to offer this afternoon. So I am going to talk, I am Fernando Alvarado, the CEO of Deetken Impact Sustainable Energy. As I will explain, I want to tell you a little bit more about what we do. Essentially, we are impact investors. We invest in renewable energy and energy efficiency projects in Latin America and the Caribbean. So essentially, that's what we are. However, in this occasion, we are acting as consultants for the USAID for the promotion of sustainable energy by developing a pipeline of projects in 14 countries in the Caribbean, including Guyana, of course. So this is what I'm going to talk about, but before getting into, let's say, the specifics of this program that we have named the Caribbean Inclusive Climate Finance Initiative, or CICFI, I'll be talking a little bit more about what we do such that you can understand what are, let's say, our credentials to provide the kind of services that we're going to be offering with this initiative. So Deetken Impact, and a division of which I manage called Deetken Impact Sustainable Energy, is essentially a professional fund manager that channels capital from multilateral and developed entities and development banks and private sector investors that are pursuing financial, social, and environmental returns. So we create specific investment funds that are usually specializing on certain sectors. In the case of Deetken Impact Sustainable Energy, which is one of the two verticals that we manage through our group, is about investing funds that we have created in renewable energy generation, both utility scale and distributed generation, as well as energy efficiency, which is also very important in the Caribbean given the cost of electricity. But as a group, and we have colleagues that are located, some in Vancouver, some in Mexico, Central America, I am in Costa Rica, we have some other colleagues in Guatemala, Honduras, and through those offices, we cover, let's say, the region and look for investment opportunities. We have right now total assets under management of $145 million, and I'll give you, let's say, a breakdown more or less of the kind of investments that we have made in the last 5-6 years. We manage 5 funds. 3 of those are more open sector in this vertical that we call Deetken Impact Alternative Finance. We have invested in fintech, healthcare, education, microfinance, whereas with the 2 funds that I manage directly, the sustainable energy funds, as I explained before, and you will see it later, it's mainly generation with renewable energy as well as some energy efficiency. And we have been active so far in 18 countries. And in addition to our investment activity, and this is actually what brings me here today, we also take on certain technical assistance engagements with some donors or entities, such as the USAID, for specific purposes that are related to either addressing climate change or empowering women, these kind of projects and companies and sectors. The other thing that I wanted to mention is that we have networks, relationships, and affiliations with a diversity of entities, development banks, NGOs, impact organizations, etc. So, for example, you can see that here in the list of investors that we have entities that are very active in the region, such as the Inter-American Development Bank, as well as European development banks, such as FinFund, the FMO, DEG, etc., and then affiliations to certain organizations, such as the Latin American Venture Capital as organization, and the Global Impact Investing Network as well. So this just to show that through working with our CICFI program, in a way, people are having access to all those entities, whereas normally if you were to try to do that directly, it's either difficult or too time-consuming. Covering or considering the total Deetken impact, or the 5 impact funds that I mentioned before, this shows more or less in what kind of projects and companies we have been investing over the last, I would say, 6 years more actively. So as you can see, the majority of the investments are, let's say, Central America and South America, specifically Andean countries. The Caribbean, we're more active in the Dominican Republic, in Jamaica, even though we have been considering recently investments or investment opportunities in Barbados, the Bahamas, and we have seen in the past some opportunities here in Guyana, but so far we haven't actually closed any particular investment. And our colleagues in Vancouver actually have done a couple of investments in North America in the past that have been actually exited already. This is the portfolio of the sustainable energy funds that I manage. So this is more specifically like, you know, the location of the kind of investments that we have. And right now we have reached 16 investments in 7 countries for an aggregate installed capacity of 300 megawatts approved, and 100 of those 300 already installed today. And we're actually in the process of building some of the larger generation utility scale solar plants. By the way, the majority of our portfolio, I would say more than 80% of it, is solar PV generation, which is obviously the most abundant in the Caribbean, especially in the island countries, whereas here in Guyana you have a lot of hydroelectric potential, as we have in Central America, but nonetheless, solar has proven to be very competitive nowadays, both on utility scale as well as in distributed generation, which is another sector in which we also invest. And so the 2 funds that I mentioned before that I manage are pretty much invested nowadays. And we are in the process of raising a new fund that we are going to call Fund 3. And the difference with respect to the previous 2 funds is that the first 2 funds were more project finance funds. So we would invest when the projects were ready for construction and implementation. And we have learned in the past that we have lost many interesting investment opportunities had we participated earlier in those projects and companies when they were developing the project and in that phase. And so the next fund is going to also include the possibility of investing earlier stage in the development phase. That, from a point of view, is interesting not only because it would expand the opportunities or the pipeline, but at the same time would be also important to, let's say, de-risk the projects when they get implemented, because by having obviously more resources, better studies could be performed, et cetera, and we could also bring our experience in the implementation of different technologies to the full feasibility and investment readiness of those projects. So that, just to tell you a little bit what we have been up to more recently as an investor itself, per se. Now, some of the value adds that we bring, because yes, we are investors, but at the same time we develop relationships with our clients, and we actually take active role in the boards of most of our investee companies. So some of those value adds, in our opinion, is a regional investment experience. We have seen many things, many situations that go well, but many that go wrong, and then having to actually solve those problems and issues. And we are a different fund manager in the sense that we have technical know-how in-house So we actually take an active role when it comes to the actual supervision, acting at times even as owners, engineers ourselves, and when it comes to the actual operation of assets. So we have, for example, to mention a few cases, run-of-the-river hydroelectric plant in Honduras that we fully operate, as well as 2 solar plants, utility-scale solar plants in Panama, where we do the whole operation, as well as obviously being the majority owner of those projects. So that practical experience is something that we are also offering by engaging with this program that I'm going to be talking about. We, at the same time, are impact specialists. That means that when we invest, we identify not just the financial returns of the investment opportunity, but also the social and environmental. And this matters because, as we have seen more recently, financiers, more and more, firstly driven by development banks, but more like also commercial banks have embraced this, they take social and environmental impacts under consideration, not just to ensure that the projects are going to have long-term sustainability, but also because themselves they need to report on those impacts. And that is actually opening the door to negotiating better terms and conditions on, for example, on loans by setting certain social and environmental milestones. And so this is part of the know-how that we also bring to the table, and based on very practical transactions. At the same time, we provide comprehensive support. So it's not only that we would advise, let's say, on the financial structuring, but we also look into the commercial aspects of, let's say, selling energy, legal, ESG, of course, and technical as well. So from that point of view, we are acting here as consultants, but with a lot of practical experience in almost all the areas of designing and implementing and operating a project. And then the fourth element, which is not so widespread, but is becoming more and more very relevant, not just for raising capital, but when actually operating a project or a company, especially in the energy space nowadays, is whether the companies are really opening the door to the empowerment of women. And this is not, as I'll explain a little bit further, not just with respect to, let's say, creating job opportunities, but there's more, let's say, elements or lenses to gender, lens investing and gender inclusivity that, in our opinion, are not necessarily important just because it's the right thing to do, but at the same time because are beneficial for the profitability and the sustainability of those investment opportunities, which is obviously very relevant. So what is, let's say, the context in the Caribbean? It shouldn't be a surprise to most of you that, let's say, creates the conditions for us to come here with this program. The first, and we see, read about this and hear about this in the news every day, is how vulnerable our countries are to the effects of climate change. And so that is one of the elements to try to address the effects of climate change. The second, especially, how can I say, evident here in Guyana, is the reliance on fossil fuels for energy generation, and obviously not just the volatility of the prices, but also how expensive energy is, which obviously in turn affects the ability to implement different enterprises in other sectors. And at the same time, because normally or traditionally, the countries especially the smaller countries in Latin America, but as well in the Caribbean, we don't have developed capital markets. It is usually difficult to be able to raise, especially the equity, when it comes to completing the financial structure for the implementation of a project. So, for example, we have seen in the last, I would say, 5 years, that commercial banks feel very comfortable financing utility scale solar projects. They understand, well, the technology is not as risky as investing in hydropower or even wind power, but the banks are not going to fully finance the cost of a project. They would normally at most provide up to 80%, and then 20% has to be equity contributed normally by the project sponsors. And this is a scarce resource, and traditionally where we have come with our funds to fill that equity gap. And so this, as you will see, is part of the, let's say, value added or the service that we want to offer here, which is helping project sponsors or projects that apply to this program with raising debt financing, yeah, but more specifically, that kind of money that is more difficult to find, especially equity and let's say quasi-equity as well, other instruments that are somewhat a combination between debt and equity. And so now we come to the objectives of the CICFI program itself. This is what the program is about. Basically, this is what we have to deliver to USAID during the next almost 18 months. So essentially, we need to identify a list of projects, at least 20 projects. And we have been receiving applications already, and obviously I'll tell you soon how to apply to this program. But we have been already receiving applications, more than 24, 25 applications of different sorts. And so first is the actual identification of projects. Secondly, we are going to select 15 projects out of those that apply, following certain criteria that we have defined, the ability to actually raise capital, let's say the profitability, the potential to generate jobs, and protect the environment and empower women are some of the key criteria. I'll explain that a little bit further ahead. But so 15 projects are going to be selected, and all those 15 projects are going to receive first support in the identification of the precise stage of development, and also performing a gap analysis. From our perspective as an investor, what are those projects missing to become really investment ready? And we're going to actually provide different webinars on things that are not so, let's say, easy to find for a project developer on things like environmental and social risk management, best practices for community engagement, gender inclusive practices, etc. So all those 15 projects, let's say, are going to receive a standardized training, but tailored gap analysis and work plan preparation. 5 out of those 15 projects, the 5 that we consider that have better chances of actually raising capital within the next 12 months are going to receive full support from us as if we were investing. And it's possible that through our funds, we could invest actually in some of those projects. But in any case, we are going to take those projects through our whole investment process as if we were investing, help the project sponsors with the refinement of their business plans, investment documentation, investment decks, teasers, and engage on fundraising negotiations with banks, investors, funds, etc. So with the objective, obviously, of raising the capital leading to the actual implementation of those projects. To give you a better idea of the kind of projects that are eligible for the program, and this is very broad, different from a technology point of view, very diverse, renewable energy, biomass, wind, energy efficiency, biogas, solar PV, hybrid solutions as well, cogeneration, run-of-river hydro, battery storage, and clean tech. And it's important to mention this because this program is not only open to renewable energy generation projects, but also to clean tech companies and projects, meaning using certain technologies that could be based, for example, on the Internet of Things to address environmental problems and address climate change. So from that point of view, it is not just limited, again, to generation projects, but also it can be more like companies that are targeting, let's say, the open market and trying to scale up as well. Because whereas energy generation projects are usually, once they are built, they offer very stable and predictable revenues, but they normally don't have an important upside. It's almost like a machine. Once it's there, it is what it is, unless you actually do an expansion, but that could be considered as an additional project, whereas, let's say, a clean tech company would be one that could potentially have the ability to grow either regionally or in the same country, et cetera, or even globally. That is also something that we could support. And we have in our portfolio actually an interesting case of a company called Hybrico. If you look for it, it's a company based in Guatemala that what they do is they manufacture with their own IP tailored solution that combines solar power, solar PV, battery storage, and efficient diesel generators on a containered solution to power telecommunication towers of the telecom companies in Central America, South America, and eventually in the Caribbean. So that is a company that is growing a lot, and it was more like a venture capital type of investment that we did, but it's addressing climate change, but also an example of a company with a substantial upside potential. The countries that are eligible, you have here the list. It's 14 countries. So not necessarily just the large countries that usually draw most of the attention or the investment flows, such as Dominican Republic or Jamaica now with their ongoing tender for more solar power, but other countries, as I mentioned, of course, Guyana. And here you have the list. And lastly, it's worth mentioning that we, as I mentioned before, we want to put a special emphasis on projects that have that potential to generate impacts. So not necessarily just very, let's say, solid from a business point of view or the ability to generate returns and pay back investments, but also to generate impacts, environmental, social, and be open to implementing gender inclusive practices. Those projects that are either established or are mature or are, let's say, positioned to potentially grow more by means of our support would probably receive a higher score as we are screening right now the projects that are applying. And it's also important to mention that we want to work with very enthusiastic and engaged project developers, because it is not that our team is actually going to be writing business plans or doing the financial modeling for those projects. We are going to mentor them and look at them, revise them, give feedback, and so on. But so from that point of view, we expect the project sponsors to actively engage with our team to try to advance their projects. So more or less, in summary, why work with a program like CICFI? Well, firstly, you're going to be receiving expert advisory one-on-one from investors. So it's not like when you hire a consultant, that a consultant may be very experienced, but it's not like the investor put their own money at risk, whereas that's what we do. And we have lived through all, as I mentioned, the things that go right and those that go wrong. And so you're going to be benefiting from those lessons learned with very practical examples in this region. So that expert advisory, as I was mentioning, is very open to different aspects, not just the financial, but also like legal, ESG, et cetera, et cetera. Like, for example, with some projects in which we are investing, we participate actively in the EPC contract negotiations between the project sponsors and the potential companies that are going to build those projects. And by virtue of that participation, we managed to obtain substantial cost reductions on the EPC component of the project. So that, for example, is something that we have experience doing. At the same time, we are going to help getting the projects to investment readiness. That's the ultimate target. So from that point of view, we are going to try to focus on those things that we believe could be hindering the ability to actually take the project to an investment readiness phase. And so from that point of view, it's a very practical approach. As I showed before, we have an extensive network of different organizations, investors, banks that we work with, and that is obviously going to be put at disposal of those that apply to this program. And last but certainly not least, our approach to inclusive impact. As I mentioned, we are seeing how ESG, or properly and in a systematic way addressing environmental and social risks as a way to ensure long-term sustainability, is basically nowadays mandatory in almost any institution, financial institution that I can think about. Development banks, of course, but commercial banks have really adopted these let's say, policies, guidelines, etc. But the impacts, or pursuing impacts with gender inclusivity, is something that is gradually also percolating from development banks to commercial banks. And for example, we have an investment in a company in Jamaica that offers turnkey solar PV solutions for commercial and industrial clients, led by a woman. We injected equity in the project company or the asset company, and with that equity injection, we were able to leverage. We invested $4 million. We leveraged a loan from the Inter-American Development, the IDB Invest, the private sector branch of the IDB, for $24 million. So big leverage effect there. But what is more interesting is that the IDB offered a certain preferential interest rate if certain gender milestones were achieved. Otherwise, the rate would go up by like 150 basis points. So imagine if you had to pay 1.5% more on $24 million over time in 10 years versus having a preferential interest rate. And so in the loan agreement, there are very specific gender milestones with respect to the company having policies against, obviously sexual harassment, et cetera, but also certain very specific targets about training women on the installation of solar panels, in general, creating opportunities for women, and also in the value chain of the business. And we provided that kind of support to our client to ensure that preferential interest rate could be achieved. And that example, for example, we are seeing also replicate in the negotiations with other development banks that are obviously financing these kind of projects right now. So we think that it's going to become more and more important if you can actually come when you are starting to raise capital with a very specific work already performed in this area. I think that we're going to be able to have better chance at optimizing, let's say, the terms of the financing being pursued. So we have 5 lenses for gender equality, the Sustainable Development Goal number 5 of the United Nations. So we would work on women in leadership, because it's not just about creating jobs for women, but ideally also having opening space for women in the shareholder group or board or C-suite level. Considering gender on the definition or the design of products and services and its marketing. Something that sounds very basic, but when we start by performing let's say, a revision, we have certain tools that we apply to the projects in which we invest, basically a scorecard to identify where the projects are with respect to gender inclusive policies and practices, we find that workplace equity still has lots to be improved. And so we work as well in this area. Value chain equity and advocacy, reaching, for example, projects in which we're investing, let's say generation projects, not just the company itself, but also trying to reach its contractors and suppliers as well, such that they have all these practices under consideration. And very importantly, on the community engagement. Our investment funds typically have, in addition to the investment facility, we have a technical assistance component that we can use to promote certain community development projects. So because usually when you have, let's say, a solar project is reaching a certain community, the community would be expecting some sort of benefits, right? Whether it is a donation to the local school or improving a road or those kind of things. And those are usually always considered in the cost of the project, but we also want to encourage the implementation of more permanent businesses, usually from the community, that can continue delivering benefits for many years. And so through the technical assistance facility, we try to also engage with local women-led organizations to try to understand what are those community projects that the local, let's say, towns around the project would want to implement. And then we provide a combination of technical know-how and non-reimbursable monies to actually get those projects started. And so we have seen the tremendous value of engaging, again, women leadership from the communities for the implementation of the projects. And that know-how is also something that we are bringing to this program. We have a team. These are some of the colleagues that helped me on this program. We have, my colleague Alexa Blaine is one of the co-founders of Deetken Impact based in Vancouver and a managing partner. But we also have very experienced engineers that have implemented many projects, not just solar, but also hydroelectric projects in complex working environments. And that's why I was explaining that we are a particular type of fund manager, because we have very practical know-how, as well as experts in gender and impact, and colleagues such as Laura Sanz from Spain, actually, who moved to Costa Rica years ago, who, as a personal project, like 15 years ago with a group of friends, they developed their own solar projects as entrepreneurs, and still have those projects. So with very hands-on experiences that become, let's say, important when managing our investment opportunities. So how to work with CICFI? The process started more than a month ago, and we communicated it firstly through our virtual channels, but it's important to have these country presentations, and that's why we're here today in Guyana, because we start with a request for project proposals. As I mentioned, like 20-something projects have already applied from different sectors. You can still apply until the end of April, and I'll show you the link to the application template soon. You have to obviously apply using that template online. You will see that the template tries to capture substantial information. It would probably take, my guess, an hour to fully fill the template if you have all the information, but you don't necessarily have to have it all in order to send the application. You can apply with the information you have, or you can start putting the information, save, and then come back later on and continue until you fully fill the application and send it. As soon as you send it, that information comes directly into a database that we have, and from there we start assessing the projects and scoring them for this process, in which we're going to be, step 3, in which we're going to be selecting the pipeline. And then once we select that pipeline, at the end of April, beginning of May, we're going to be communicating with the project sponsors and gradually coordinating the work ahead. Following step would be to start attending the webinars that we have ready, more like to level the field for all the project applicants, regardless of the sector of their projects. There could be generation projects, energy efficiency, clean tech, etc. And then in this same step 4, we're going to be working on that gap analysis that I mentioned before, and then with the help, or let's say in coordination with the project sponsors, be producing those work plans that are tailor-made, specific for each project, to define the roadmap to take the projects at the stage where they are to investment readiness. 5 of those 15 projects, as I mentioned before, are the ones that are going to advance to step number 5, which is full investment readiness, working with our investment and technical and ESG teams to fully have bankable projects with a business plan, investment decks, etc. And with that, we move into the final step, which is to actually engage in conversations and negotiations with capital providers, whether they are lenders or investors. They could be potentially institutional investors, such as the investment funds that we represent, or eventually strategic investors, maybe companies from the private sector. We are seeing actually that happening actively in the Dominican Republic, in Jamaica as well, whereas there are groups from Europe that actually are active in oil and gas, but have a mandate to invest more and diversify in renewable energy, and they are coming to invest in some of our investee companies and potentially buy part of our assets. So we're seeing those kind of opportunities now, interestingly, and so that's why I mentioned that the list of potential investors or participants to engage in conversations with is diverse. Actually, something that I should have mentioned before, you're going to see it when you go into the template. We ask information on not just the amounts of capital that you need to raise, but also what kind of capital you are looking for, whether it is debt or equity or grant funding, because maybe there's a project that needs some of that, and so in that case you will be able to, fill the box and specify exactly what type of capital and for how much you need to raise. This, if you scan this QR code, it's actually going to take you to the, you can take a picture of it or even just, go there, and it takes you to the application template directly. And then you can, save that, add that bookmark, and then revisit it later for your convenience. And then lastly, I realized that perhaps, it would have been interesting to share some of the cases or the, cases or investments that we have made over time, particularly with our sustainable energy funds. But you can access actually that information if you visit our webpage, Deetken Impact. You go, I think that we don't have the URL here, but it's www.deetkenimpact.com, and you can actually find information of the different projects and companies in which we have invested. We talk about not just the amount of the investment and the instrument, a short description, the business model, et cetera, et cetera. If in the process of when you go into the template, you're going to actually find information. If you have questions when you're trying to apply, feel free to write or get in touch with us. Again, you're going to find that contact information there in the template, such that we can, or you can just send us an email and we'll be happy to answer or help you with the completion of the template. So in summary, that's what we had to present today. Again, it's a program to support project developers free of charge, because this is at no cost to project developers. That's what USAID is paying us to do. And our role, again, is to try to mobilize capital for as many projects as possible and hopefully get some projects implemented in the next 12 to 18 months. And I'm going to stop here, and now perhaps we open the room for questions that you might have. So feel free to raise your hand and we can go one by one. Yes?
Question. You're operating in a bunch of countries with different currencies. Generation power tends to be local revenues. Sounds like you're making hard currency investments. Like, how do you guys manage the foreign exchange exposure?
Yes, it's a good question. With our sustainable energy funds, not that we couldn't actually make local currency investments, but the reality is that all our investments have been in US dollars. With power purchase agreements, even if they get paid in local currency, there's usually indexation to not just inflation, but also to devaluation, right? So from that point of view, we are ready to take those risks, yes. And in this case of the program itself, it doesn't matter if the project doesn't necessarily generate US dollars, because we are here to assist with raising capital from different sources. So it could be actually from local currency sources. We actually take FX risk to a certain extent by diversifying the portfolio when we invest in distributed generation. So for example, because our minimum investment with the sustainable energy funds that I presented before is $1 million, but we want to encourage, let's say, distributed generation projects that at times are less than a megawatt, therefore smaller than $1 million of investment. So what we have done is we have created special purpose vehicles that allow us to inject equity into them and bundle smaller projects together. So it's more like a portfolio approach. We create some sort of a leasing company. All the projects are assessed following a certain pre-established criteria, technical and financial, by us. And if the projects meet that criteria, we can certainly finance them through the leasing vehicle with the equity that we have injected. And at times, those DG projects are installed in commercial or industrial companies that just produce some products or services for the local market. They don't have any foreign currency generation. In that case, we have to assume the currency risk. Normally what happens is that the solar installation relative to the magnitude of business of those companies is relatively small. So it's a risk that could be almost like assumed relatively quickly. Well, and as I said, we sort of try to diversify by not putting all the eggs in just one basket, and therefore be better positioned to assume that currency risk. Yes, please.
Participated in some of these projects, your exit strategy, or is there one?
Yeah, so because the projects that we are going to support with this program, CICFI, in theory, have not been implemented. Exit strategy is not necessarily something that will be so relevant for us at the moment. However, is something that would be very relevant for other investors that would be considering putting money in those projects that we're going to introduce to them. And so from that point of view, we have to carefully assess, and this is part of the services that we will provide, the financial viability of the projects and their cash flow generation, and the ability to meet, for example, from the perspective of lenders, debt service coverage ratios that are relevant for commercial and development banks, and then free cash flows after debt service for equity investors precisely such that then they can have a good understanding of by when those investments could be exited. So yes, we are familiar, let's say, with all those kind of analysis and decisions when we are investing, and that's part of, let's say, the considerations that we are going to bring when supporting project developers.
Does the website have like deal structures?
Yes. As I mentioned, you're going to find some case studies there, a good number. I don't know how many we have, but potentially I'm thinking like perhaps some 8 out of the 16 or 17 investments that we have made, and we tried to have a combination of different projects, not just the utility scale, but also distributed generation. And so that gives you an idea, but our approach traditionally has been more flexible. So we don't have a cookie cutter approach. We don't have like predefined terms for investing. We treat each project differently, and that's why I think that there's value in working with us, because we look at the reality of the project. Something else that is also important to consider is what is the preference of the project sponsor or the developer. Maybe it's a family-owned business. They are not so eager to dilute themselves or to open to other shareholders. So from that point of view, something that has worked very well for us in our investments is that in those cases where the family doesn't want to open to other partners, they will continue retaining 100% of the common shares, but we create a separate issuance of preferred shares that gives obviously a preferential dividend, but no voting rights, for example. And some investors like us could be perfectly fine with that. And so that helps the purpose of raising the equity that is needed to leverage the debt, and at the same time, is something that is acceptable to the project sponsor from the point of view that it's not diluting them in the project company. So we are used to creating like different structures to see what works well, not just from the point of view of what the project can generate financially speaking, but also the legal structure that adapts to the preferences of the project developers.
Sorry, on that one, preferred shares, if you get into a business based on preferred shares, does that then attract a higher risk portfolio and therefore a higher interest?
Sorry, Andrew, I didn't.
Sorry. So if you do the preferred shares route, say,
yes.
as you say, it's a family business, they don't want to give up shareholding.
Sure.
Say. So you do preferred shares, obviously with preferred dividends, you say, does that then attract a higher interest for the loan?
Yes.
Higher risk, obviously, because you have less.
Yes.
The investor have less say.
Exactly. And so when we structure a preferred share investment, normally we would be subordinated to the senior lenders, usually the banks. The banks continue having all the guarantees. That's what they do. The banks don't take, let's say, equity or quasi-equity risk. They want to have the guarantees and a senior position. If we come with a preferred share issuance, we will go second after the senior banks have been paid. We go second in dividend distribution, and then junior to us would be the common shareholders. But then obviously the common shareholders, once they have fully serviced the senior debt and the preferred shares, anything that is left, they can almost normally in an unrestricted manner, provided certain cash reserves are met, then they can distribute all the dividends that are left. So from that point of view, the kind of preferred shares is a structure that we have seen works quite well in project finance of infrastructure projects. Yes.
What sort of debt covenants you see, and how pervasive are they with respect to these kind of structures?
They tend to be standard in the sense that even though the commercial banks would like to have all the guarantees and cross guarantees and fiduciary guarantees and what have you, but there's so much competition nowadays for these projects that the banks understand that this has to be non-recourse financing. So it's pure project finance. The main guarantee for them is the cash flows of an operating project. If the project goes out of business and they need to actually collect the assets because the assets are going to be pledged to them or the land is going to be mortgaged to the bank, but monetizing those assets is usually going to be at a loss to the bank because normally it's not very liquid such that you can actually, well, you could take panels and eventually put them in another project, but there are some other things like the structures or the inverters that are more, talking about a solar project, that are more specific. It's not so easy to monetize them, and if you do, then probably because the technology evolves so fast that they would actually lose value. So the banks understand this, and they are usually very, I would say, standard in the sense that is pre-project finance, meaning the guarantee is the cash flow. Normally you would create a certain trust mechanism that manages the cash flows from whomever is buying power from those projects, and then obviously servicing a waterfall, making first payments to the banks, and then feeding some cash reserves, et cetera, and following a certain waterfall. And then with respect to financial covenants, what we have seen is normally a certain debt service coverage ratio that can be as low as 1.1 times the available cash before meeting the debt service, and up to 1.5. I think that's more or less the range. That is usually the first financial check before deciding whether dividends can be paid, and then there might be other ratios such as liquidity ratio. And so if a certain liquidity ratio is present and the debt service is current, and the cash reserve, because usually also banks want to, and this is something that we have seen is very important and works quite well, which is creating a cash reserve that is equal to 1 or 2 quarterly payments of the senior debt. Because there are times that there can be lower generation due to adverse climate events or just simply, damages to the equipment or what have you. So before the insurance kicks in, it's good to have a cash reserve. And so this is something that is almost standard when structuring project finance for infrastructure projects.
When you say debt service cost, you're talking P&I, principal interest, or just the interest?
No, when I say debt service, everything. Everything. It's principal and interest, because normally there would be a grace period, right, of a few months, and the grace period used to be long in projects that required a lot of time to get built, especially hydroelectric projects, but solar projects can be built in a few months. So yeah, the banks during that time would not collect interest. The interest during construction would be part of the cost of the projects. Once the project starts operating, they would normally have a certain grace period on principal, but they have to start paying interest right away. And then after 6 months, but usually not more than a year, then principal amortization has to start.
Many of these projects I'd expect would take probably more than 2 years, at least 2 years, right?
You mean to develop?
To develop.
To develop, yes.
When the debt starts kicking in, it puts you under enormous pressure.
Yes, perhaps it's worth explaining that, because one thing is to develop a project until it gets to investment readiness. And this is the kind of support that we're going to give to the project developers. By then, by the time you get to investment readiness, in theory, you don't have debt. Normally, you're developing those projects with equity, own funds, maybe some passive investors, or even active investors, such as the investment funds that we represent, but there's not a pressure to make debt payments. It's only when the actual disbursement of loans for the construction of the projects comes in, that then you start generating obligations to pay interest and eventually then amortize the debt. So from that point of view, we are understanding or thinking that, yes, we're going to be working closely with the projects that are selected for, let's say, 12 to 18 months while their projects are developed, and negotiating investment agreements but there won't be any financial burden until the financing is actually signed and disbursed. So from that point of view, I think that that's like the strategy. I mean, we have seen in the past, and actually I had some funds years ago that did take or provided project development finance as contingent loans. So like, for example, to develop a hydro project, you needed $500,000, and so our fund would assess the project if it made sense, and we felt that the resource was good, having a PPA was possible, and so on. We would make a contingent loan, but because the project was not implemented, then there wouldn't be any requirement to get interest payments. Interest was accumulated until the time when the project closed financing for its implementation, and then after that happened, then our loan would get repaid. That's
Is that
something.
interest PIK interest? Is that interest typically PIK interest, paid in kind, that increases?
Yes,
It does.
it does, exactly. So you are capitalizing everything, and then once the project closes financing for its implementation, you service that loan, or eventually, as we have seen as well, there are some funds, like we did in the past, that we also had the option to convert that loan into equity at a certain pre-agreed, valuation. Because depending on what happens at the end, maybe the early stage lender might be actually inclined to become an equity participant in the project company, provided, again, the project developer is open to allowing that financier into the project shareholding structure. Maybe not, right? So it is on a very case-by-case situation, but this to say that we have seen, and there are still funds and different, let's say, companies looking for this kind of early stage investment opportunities to inject capital and therefore have a participation and then decide if they really want to stay for the actual implementation or if they want to exit before the project actually gets started.
Just wanted to make a couple of quick comments on Dr. here.
And those kind of projects, like if a company, like an industrial company, wanted to implement a series of measures that involve energy efficiency and also linked to, let's say, self-generation plus e-mobility as a comprehensive project to optimizing the energy resource, let's say, that is something that would be eligible for us. And we have experience assessing those kind of projects. Would be fantastic to look. And I think that there would be interest from some potential investors and lenders to consider those kind of opportunities. Now, we have not set necessarily a minimum size of project, but ideally, we would prefer projects that, start, let's say, at $1 million and up, ideally, because I think that from that point of view, our networks, the kind of, financiers, the relationships that we have with banks, both developmental and commercial, would be better exploited, let's say, than if we were targeting very, very small projects. On the upper end, like we have already applications from some projects from the Dominican Republic, several, with solar farms with installed capacities in excess of 50, 60 megawatts. We're not saying no to them, but to be honest, USAID would prefer that we stay at a more, let's say, contained range of, I would say, ideally, like a sweet spot could be between 5 and 30 megawatts. That would be like the sweet spot. But again, we are not limited to projects that are smaller than that and projects that could be bigger than that.
Yeah, but if you look at our landscape here in Guyana, the size of what you're talking about.
Yeah.
We're going gas to shore. That's going to take up a chunk of the marketplace, right?
Yes.
I'm sure solar is going to play a role in these other green energy products, but the market isn't sizable enough to scale anything like what you're thinking. Could you?
Yes. So let's say the market, or let's say the energy generation infrastructure or the installed capacity, let's say here, is small as compared to other countries. But you saw the list of countries, and there are countries that are even smaller than Guyana in that respect. And USAID actually wants us, and we're trying to make an effort to actually source projects from those other countries as well. There might be instances, and this is something also to consider, of perhaps projects in small countries, but if they are taken with a regional approach, as for example a company from St. Lucia that applied already, that is targeting OECS countries, a combination of them, a market that is not maybe very well serviced precisely because it doesn't necessarily encourage big players given the size, that is something that could be interesting for us. But considering not just one country, a company from one specific eligible country, but is targeting obviously with a growth plan, not necessarily studying in all those countries right away, but with a growth plan that makes sense to penetrate gradually those markets. But the regional approach is always very attractive. And that is part of the relationships that ourselves as investors in the Caribbean, we have tried to develop, because yes, like finding deals or good deals takes time and effort and resources. So we are usually also focusing on developing relationships with groups that we know that have high standards, that are very serious, that would be generating opportunities time after time. So once you consolidate and trust that relationship, you deploy capital and you continue just adding more projects almost organically. And that's usually the preference of investors. So from that point of view, I would say that those that are targeting or thinking more like regionally, also, would be, that would be, let's say, gaining extra points in the application process. Yes, a question back there.
You spoke quite a bit about adaptation in your projects.
Yes.
You also mentioned that interest rates might potentially be tied to when these targets will be met. You have suggested target percentages that should be adhered to the different stages or the different goals.
When you said percentages, do you mean interest rate, different interest rates, or? Oh, women.
So how many women in the C-suite, how many women at the basic technician level?
Yes, I have to say that on average, I understand that the energy sector on average has less than 30% representation of women, right, in this space. So anything that at least, targets that percentage, I think would be considered positive. If it excels it, obviously even better. But at the same time, we have to be realistic. And for example, in this one company that I was mentioning from Jamaica, it's led and owned by one woman. So 100% of the shareholders are women. It's fantastic. And in terms of jobs, or one of the gender milestones that was agreed with the IDB was training 15 women on the installation of solar panels. I don't know why they said 15 and why not 20 or 30. Maybe it was considered something reasonable that could be achieved, given also at the same time, let's say, the number of women in studying technical or engineering careers. Yes.
I'm the IDB representative, so I can answer the.
Oh, okay.
So it depends on project by project. For example, here in Guyana, we understand and we know with Dr. Sharma is our partner in this action. And especially, for example, for the solar, you had zero before the program. Right now, we have several women that we have targeted in Barbados and let them train soon in India. Women that is more than 50 women in the areas, right? And also, in an initial stage, kind of training on EV, operation, maintenance, and over that program, we have 2 women.
Might be more.
It was initially was 2. So it depends on the to the transport sector, for example, in other countries, we have 400 women working in the transport sector, in the operation of the, not just the construction of the road, but at the management level. Here in Guyana, you have less, because it depends on case by case and analysis that our ESG team on the public sector or the private sector wants.
So your assessment would always be based on specific project.
Correct, on each specific project. Yeah. Okay.
Thank you.
So,
Yes. Yes, Andrew.
couple things. One is on the energy efficiency. Do you guys also have capacity to provide technical support to do energy efficient audits and then come up with proposals for companies? It's obviously cheaper to save electricity.
Exactly.
than invest in generation.
Yeah.
You know, with
Yeah.
our offices, when we built it, we spent, I think, maybe $50,000 US out of $5 million US in constructing it, high efficiency air conditioning units and insulation of the building. Similar size building in Georgetown, it costs about $15,000 US a month in electricity. That building we have is $4,500. So since we moved in, we've saved over $1 million.
Exactly.
And it was just spending $50,000 extra in the beginning, and that made a fundamental difference. I'm just putting it out there to give you a sense of where the opportunity is. You know, and that's when you have the money available.
Yes.
When you have capital available.
Exactly.
for your mortgage. So is there one technical capacity to build that? I know they're called what they call
ESCOs.
ESCOs, right?
Yes.
To build that capacity.
Yes.
One.
Yeah.
And then two, the second part is to help these projects. They're all nice and stuff, but the problem is it's kind of about sustainability going forward. So O&M, building out O&M capacity
Yes.
to manage and maintain these.
Exactly.
So what does the technical support of those two
Yeah.
aspects sort of look like from your side?
Yeah. Yeah. Well, first, we do have experience on energy efficiency and actually investing. We have one of our portfolio companies is an ESCO, one of the oldest that I know about, that I've known since year 2001, based in Trinidad and Tobago, but implementing projects all over the Caribbean. And they are at the same time consultants for USAID, IDB, and other organizations, United Nations, on precisely energy audits on certain sectors like the hotel industry, et cetera. So yes, there's the whole concept of energy services, which is essentially we start by performing an energy audit to understand where are the opportunities to conserve energy by implementing modern equipment, whether it is lighting, air conditioning, electric motors, et cetera, and such a capital expenditure investment would be recovered from the savings to be generated. And usually the paybacks are less than 3 years. So from that point of view, you would think, why isn't anyone that has, let's say, a management position in a company focusing on those? That's like cherry picking, right? It should be obvious to go first with that and then eventually focus on the energy generation component. But somehow I think it has been a little bit challenging to widely or implement those practices and that business. And one could say, well, it's a lack of capital, but we have created vehicles and actually invested in energy efficiency, and still this is almost similar, and I find, again, similarities between distributed solar power and energy efficiency in the sense that you could actually bundle those smaller projects together in a certain vehicle that would be almost like a leasing solution, and you offer a turnkey solution with the engineering, the technology implemented, the financing such that the end user doesn't have to spend a single dollar, and something very important that you mentioned, which is the operation and maintenance, because as soon as some of those equipments start malfunctioning, then people just abandon them and the whole project collapses. So from our point of view, when we have actually invested in energy efficiency projects, the O&M is very well assigned to professional company that usually is the same company that did the EPC, but not necessarily, and they are factored, the cost of the O&M is factored in the monthly payment or quarterly payment that has to be collected from the end user, the one benefiting from the savings, and that is obviously included in a contractual.
On that, if you have then a trusted O&M partner who manage the project on an ongoing basis, then that sort of de-risks the project and should attract a lower rate of interest.
Yes.
So then the interest saving should more than pay for the O&M cost.
Yes, and to try to align the interests in the long run as well, we even in these vehicles that we have created for energy efficiency or energy as a service, we have also provided certain participation or profit sharing, let's say, to the EPC and the O&M. If it's the same company, to the same, such that they have, let's say, an interest to ensure that the project performs well or the projects in the long run. Because especially our exit will take time. Normally, because we want to also, and this is the thing, energy efficiency is interesting because at times the companies say, wow, I could experience all these savings. I want 100% of the savings for myself. I'm not going to share them with anyone. So I'm actually going to put the money, our own money, and put it. I don't owe this to anyone. I am enjoying the savings. Sometimes companies don't really, or they doubt that the savings could be real. So they say, well, let's transfer part of the risk to the ESCO and let them cover the cost of the equipment, and then maybe we participate in a portion of the savings. And so it depends. If you want to have a higher participation of the savings, the term of the contract has to increase, has to extend, because that means that less money is going to go to amortize for the capital expenditures. If you allow the ESCO to almost fully use 100% of the savings to recover the investment, then the transfer of the ownership of the assets can be done quicker. Because in our case, we come in as investors. We don't need to own the equipment forever. We just want to recover our investment and make a reasonable return. How much is that return? Well, something that is priced maybe halfway between what a bank loan would cost and maybe less than an equity investment would yield. And why is that? Because it's more than just a financial service, because we would be assuming also part of the operational and maintenance risk. If all of a sudden the equipment breaks and needs to be fixed, the end user knows that all they have to do is just send an email or pick the phone and the equipment will be fixed, and there would be no obligation to continue paying the savings until that equipment is performing again. So it's more than just financing. It's a turnkey tailored solution. But I agree that if you were to perform those services, in the end, it's hitting the bottom line of the companies, regardless of the business sector. And by doing that, they're going to be more profitable, more sustainable, and in turn should also impact positively cost of capital for other types of financing that are more perhaps aligned with the core business of those companies.
What is your IRRs like for these sort of deals in your portfolio?
I can give you ranges. For example, we have returns that are, in some cases, like for example, we bought a performing asset. The hydro project that we have in Honduras was already operational. Why did we invest in that project? Because it had the capacity to eventually scale up a little bit more. So we saw an opportunity, but because it was already operating, then the owner sold it, and our return is 9%, let's say in dollars. Very low risk. It has a very fantastic PPA, good rates for 20 more years still on it.
What about the more venture-like deals that you're in, rather than the private equity ones that you mentioned? The more high risk.
Right, and then I was gonna say in distributed generation as well as utility scale, we are seeing leverage returns of between 11 and 12%, more or less. Our assumption when we created these funds 6 years ago was that we were going to make high teen returns, 15, 17% returns at the investee company level by coming with preferred share investments and what have you. The reality is that the markets are so competitive, both at the utility scale and the DG, that the returns are not that great. And consider that in the last 2 years, we have also been subject to extremely high interest rates on the debt side. So as equity investors, there's less money to be distributed to us because more has to be paid to the banks on interest. And so that has also affected the returns a bit. Whereas there are projects, a few exceptions, like a company that I mentioned, Hybrico, where we invested in their Series A round at $22 per share. Now they are placing their Series B at 80-something dollars per share, and that is in 4 years. So it has quadrupled in 4 years. That is going to be a good return. We're holding to those shares. We haven't actually monetized the gain, but it's a very different business. As I mentioned, that's almost venture capital, with a difference. That company has contracted revenues because they go to a telecom company and they say, okay, let's say Claro or Tigo, you have 5,000 towers, and those telecommunication towers are usually located in areas where if there's grid coverage, it's very bad, or maybe no grid coverage. But the towers need to be powered 100% of the time. Traditionally, they have been powered with obsolete diesel generation, so it's very costly and logistically to take the fuel to the stations and all that. So what Hybrico is doing is saying, look, I will install this hybrid solution here next to your tower, guarantee 100% uptime, and all you do have to do is sign this contract for 10 years. I am your utility. I am delivering energy to you, and it's contracted revenues. The risk is relatively low, the commercial risk, I mean, because it's large companies, market leaders, and what have you. So yes, they need to grow because obviously they are capital intensive in the sense that they need to raise capital to manufacture units and offer them and place them in these rural locations, but it's contracted revenue. So it's an interesting case of a VC with contracted revenues. You don't always have that, but again, it's VC, the returns are consistent. In private equity, usually the returns or the minimum, the threshold return is usually 25%, right? More or less. Whereas in our case, at the fund level,
That 9 to 12% as a leverage return, or that's
levered, exactly. So imagine. Whereas now the banks are getting 10% or more at times because it's like now LIBOR changed, now the base is SOFR, right? So SOFR plus 5 is more or less a market spread that is being used. Well, that's 10% or even higher. So yeah, right now it's high interest rates, but we hope that by the end of this year, they're gradually gonna start going down. And that's another reason why for us as investors, it makes sense to also invest early stage in project development. Because if you take obviously higher risks in the development, potentially you're gonna be able to capitalize on higher returns. That's part of the strategy of why also investing early stage. Yes, I saw a hand raised. You had a question, right? No? No? Sorry. Okay. Anyone else? I think we can take a couple more questions.
For those of you who don't know, I'm Fernando. I'm the CEO of the Guyana Energy Agency. So I just want to pick up a bit on what was talked about earlier, and I think the importance of energy assessments are crucial for you to understand what are the energy conservation opportunities for each of your businesses. And you can come to us and we can help you do an energy assessment for a total value of $0. And so we can do that. We have instruments. We've done more than 40 energy assessments. David Fernando is here, Global Green Growth Institute, and maybe you guys should talk because GGGI was responsible for doing a very similar effort a few years ago looking at a pipeline of projects, and the problem was the same. How do you get it up to 5 megawatts to make the scale question? So I think there are 3 key areas here that you should pay attention to. There's renewable energy, there is energy efficiency, and there is electric mobility. And together, I think they form almost that perfect package for you. And this is not esoteric. This is not things you're thinking about. These are things that are happening. Vishnu was able to do it. And I think if you look at the sun cycle, it follows your business cycle. It's 8 a.m. to 5 p.m. And for those of you who know what solar looks like, the curve looks like about that, and it peaks in the mid between 11 to 2 p.m. And it follows your business cycle perfectly. And I think we need to pilot this, we need to demonstrate it. So I like this presentation, but I think it needs to go a step further. I think we need to take a case or two and break it down and figure out, for your business, what can we do? And maybe 100 kilowatt, 200 kilowatt as a function of the kind of roof space that you have. You probably don't want to go and rent land and utilize prime real estate for solar panels. You want to use your roof space. So those of you who have warehouses or large roof space, that's a good place. You're a prime candidate. And so you look at solar and then you look at your energy efficiency things. What's happening on the front? Where are your energy demands? Are you using motors? Are you using lots of ACs? What's your energy cost like? And if you can pair REEE and then use that investment, that can be amortized within 4 years. The numbers are 4 years for grid-connected solar. They're still very good numbers. And Vishnu was able to do it in 3 years because he maximized his solar production. The more of it you use, the faster it came after your house. So I think this is an important area for us to look at. It fits perfectly within our country's low carbon development strategy. There's lots of is happening that has already happened on the government side of things, but we want to encourage private sector. Yes, panels and batteries and inverters, there are no duties and taxes on them. There are absolutely no duties and taxes on electric vehicles at this time. So take advantage of it.